Centerview Partners New York office asked this question in a recent Superday interview. The company with a high PE ratio acquires a company with a low PE ratio. Is the deal accretive or dilutive? This is one of the most common M&A questions that you'll get in investment banking interviews, and it trips people up because they either memorize the shortcut without understanding it, or they go way too deep into the math and lose the interviewer. Here's what the interviewer is actually testing when they ask this. First, do you understand what accretion and dilution actually mean in the context of an acquisition? Second, can you apply the PE ratio shortcut correctly and explain why it works? Third, do you understand the real-world implications for the acquirer's shareholders? And fourth, can you communicate a technical concept clearly and concisely? By the end of this video, you'll understand exactly how to answer this question, the intuition behind the PE shortcut, and how to do the full EPS math if they push you further. Now, if you're new here, I'm Max Adams, head coach at Wall Street Mastermind. I started my career in investment banking at Lazard and Catalyst, which are two of the top boutiques on Wall Street, and then I moved into tech PE. Additionally, I did an MBA at Stanford while doing a joint degree at Harvard, and during that time, Wall Street Mastermind has helped over 2,100 students break into top finance roles, assisted by our coaching team of global heads of recruiting from top banks like JP Morgan, Bank of America, Credit Suisse, and more. So you're in great hands here. Let's dig in. Okay, so first, what does accretion and dilution actually mean? Well, when one company acquires another, we look at what happens to the acquirer's earnings per share after the deal closes. And so if the EPS goes up, the deal's accretive. If EPS goes down, the deal's dilutive. That's it. Accretive means EPS increases, dilutive means it decreases. Why does this matter? Because EPS is one of the key metrics that public markets investors use to value a company. If a deal is dilutive, the acquirer's shareholders are worse off on an earnings per share basis. That doesn't necessarily mean the deal's bad. There could be strategic reasons or synergies that make it worthwhile over time. But in the short term, the dilution is generally viewed negatively by the market. Now let's talk about the PE ratio shortcut, because this is what the Centerview question directly is testing. Here's the rule. If the acquirer has a higher PE ratio than the target, and the deal is funded by stock, the deal is accretive. If the acquirer has a lower PE ratio than the target and the deal is funded with stock, then the deal is diluted. So in this specific question, higher PE acquirer buying lower PE target, the answer is the deal is accretive, assuming it's an all-stock deal. But you need to understand why this works, because a good interviewer will push you on the intuition. Think about what the PE ratio represents. It's the price you pay per dollar of earnings. A company with a PE of 20x is priced at $20 for every $1 of earnings. And a company with a PE of 10x is priced at $10 for every $1 of earnings. So when the high PE acquirer issues stock to buy the low PE target, it's essentially trading expensive currency for cheap earnings. For every dollar of its own earnings it gives up by issuing shares, it's acquiring more than $1 of the target's earnings. So on a net basis, EPS goes up. The acquirer is buying earnings at a cheaper multiple than its own shares trade at. Flip it around. If the acquirer has a lower PE and it buys a higher PE target with stock, it's trading cheap currency for expensive earnings. It gives up more earnings per share than it receives, so EPS goes down, dilutive. Now let me talk you through the full EPS calculation so you can prove this mathematically if the interviewer digs a level deeper. So let's say that company A, the acquirer, has a share price of $100, earnings of $5 a share, and 10 million shares outstanding. That gives us a PE of 20x and a total net income of $50 million. So company B, the target, has a share price of $50. They've got $5 of earnings per share and 5 million shares outstanding. That's a 10x PE multiple and total net income of $25 million. So in an all-stock deal, the acquirer pays the target's market cap. Company B's market cap is $50 times 5 million shares, $250 million. At company A's share price of $100, it needs to issue 2.5 million new shares to do the deal. So let's calculate the pro forma EPS. So combined net income is 50 million plus 25 million, 75. You've got 75 million, and then you've got combined out shares outstanding of 10 million plus 2.5 million, 12.5. So pro forma EPS is 75 divided by 12.5, which is $6 a share. The acquirer's standalone EPS was $5, now it's $6. That's a 20% increase, accretive. There are a few important caveats to mention if you want to show depth. First, this shortcut only works cleanly for all stock deals. In an all-cash deal funded with debt, accretion or dilution depends on the target's earnings yield versus the after-tax cost of debt. If the target's earnings yield, which is the inverse of its PE ratio, is higher than the after-tax interest rate, the deal is accretive. Second, this analysis ignores synergies, transaction costs, purchase accounting adjustments like amortization of intangibles. In a real model, those all factor in. And third, a deal being dilutive doesn't automatically make it a bad deal. Many highly strategic acquisitions are dilutive at the announcement but create long-term value. So here's exactly how I'd answer this in an interview. Great question. If a company with a higher PE acquires a company with a lower PE in an all-stock transaction, the deal would be accretive to the acquirer's EPS. The intuition is that the acquirer is using its more expensive shares, which represent a higher price per dollar of earnings, to purchase cheaper earnings from the target. For every share it issues, it's gaining more in earnings that it's giving up. So on a combined basis, earnings per share increases. And the quick rule is, in an all-stock deal, if the acquirer's PE is higher than the target's PE, the deal is accretive and vice versa. Of course, in practice, you'd also need to account for synergies, transaction costs, financing structure, but at a fundamental level, the PE relationship drives the accretion or dilution in a stock-for-stock deal. Now, if this video is helpful, hit like and subscribe and drop a comment on what you want me to record next. And if you're serious about your preparation, you want one-on-one coaching from people who've actually done this at top banks, check the link in the description. I'll see you in the next video.